Welcome to the Deep Dive. We're here to cut through the noise and really look at, how our economy actually ticks. If you've ever wondered why interest rates suddenly shoot up or how things happening globally affect your finances, well, you're in the right place. Today, we are diving deep into economic policy and financial regulation. Sounds complex, maybe, but it's basically about how governments and financial bodies try to steer this whole massive economic ship. We've got a stack of sources here to help us unpack it all. We want to get a clearer picture of the goals, the tools they use, and crucially, the rules of the game.
Absolutely. And our mission today is really to pull out the key insights for you, to help you quickly get your head around these core ideas, economic policy, regulation, and see why they genuinely matter in your daily life, whether you're, managing household bills or running a business.
Okay, so let's start there. When governments talk about economic policy, what are they actually trying to achieve? It feels like they're constantly juggling different priorities.
There really are. At a high level, most governments are chasing four main macroeconomic goals. We're talking aggregates here, the big picture economy. First up is price stability. Now, this means keeping inflation low and, importantly, controlled. Interestingly, zero inflation isn't really the target.
Oh, right. Why is that?
Well, it can actually discourage investment. If prices aren't expected to rise at all, why invest now rather than later? So inflation, you've probably heard that phrase, too much money chasing too few goods. It's basically when the money supply grows faster than the actual stuff, the goods and services available. So prices generally go up and keep going up. And just quickly, disinflation is when prices are still rising, but just more slowly. Deflation is when prices actually fall overall. Both have their own problem.
Okay, got it. So price stability is number one. What's next?
Second is low unemployment.
Yeah.
Simple enough, right? An expanding economy needs more workers, more capital.
Yeah.
That means more jobs, generally more prosperity.
Makes sense. Number three.
Third, they aim for balance of payments equilibrium. Think of it like a country's financial balance sheet with the rest of the world. It's about balancing the money going out for imports, services, paying returns on foreign investments with the money coming in from exports, services, and returns on investments abroad. Getting that balance right is pretty crucial for keeping the currency stable and trade healthy.
Okay, imports versus exports, basically. And the last one.
And number four is satisfactory economic growth. We usually measure this by GDP, gross domestic product. It's simply the total output of the economy growing over time. Generally, that's seen as a good sign of economic health.
So four big goals. So you said they're juggling.
Exactly. And here's the rub. These goals often conflict. You push hard for low unemployment with lots of government spending, maybe. Well, you risk fueling inflation. That's the classic trade-off. Or you focus hard on inflation, maybe raise interest rates sharply. You might slow the economy down, maybe even push up unemployment. It's a constant balancing act. Policymakers are always having to make difficult choices, prioritizing one goal perhaps over another at different times.
Right, it's never simple. And the economy itself isn't just static, is it? It has its own rhythm, these cycles we hear about. How do governments react to those ups and downs?
Precisely. Economies tend to move through phases. Think of it like a wave. First, you often get recovery and expansion. Things are looking up, interest rates might be low, inflation's under control, unemployment's falling. People feel like they have more money, so demand picks up. Businesses do well, share prices often rise. It feels good.
The good times.
Yeah, but then it can sometimes move into a boom. This
Yeah.
is where the economy might start to overheat. Too much demand, maybe. Prices start rising too fast. That's when a central bank, like the Bank of England here, might step in. They might raise interest rates to try and cool things down, dampen spending a bit.
Okay, tapping the brakes.
Exactly. And that can lead to the next phase, contraction or slowdown. Those higher interest rates start to bite. Borrowing costs more. So consumer spending might slow down, companies see profits fall, unemployment might start to edge up again, but inflation hopefully starts to ease off.
And the bottom of the cycle?
That's typically a recession. This is when there's a significant drop in economic activity for a sustained period. The technical definition is usually 2 consecutive quarters where GDP actually shrinks, so negative growth. During a recession, the focus flips completely. Now it's all about trying to stimulate demand and get things growing again.
We saw a bit of that stop-go approach in the UK historically, didn't we? Accelerating, then braking hard.
Yes, particularly in the 60s through to the 90s, that was quite characteristic. Governments trying to manage these cycles, sometimes quite abruptly.
And you mentioned inflation targets. How do we actually measure inflation? What's the yardstick?
Good question. In the UK, the main measure used for the inflation target is the Consumer Prices Index, or CPI. It basically tracks the price changes of a whole basket of goods and services that households typically buy.
Like bread, milk, petrol, that sort of thing.
Exactly. Hundreds of items. And the Bank of England's job is to try and keep the rate of CPI inflation at their target. In the Eurozone, they use a similar measure called the Harmonized Index of Consumer Prices, or HICP. These indices are really vital tools for policymakers.
Okay, so we know what they're aiming for, and we know the economy goes through cycles. Let's get into the toolkit. How do they actually try to steer things? First up, monetary policy. What's that all about?
Right. Monetary policy is primarily about controlling the amount of money circulating in the economy. And the main lever they use for this is manipulating interest rates. The primary goal, as we've said, is usually managing inflation. The thinking generally is that inflation often stems from too much money being created, mostly through bank lending, credit creation.
So how does it work here in the UK? Who decides?
In the UK, it's the Monetary Policy Committee, the MPC, at the Bank of England. It's a committee of 9 experts, some from the bank, some external economists. They set the main interest rate, which is called the bank rate. You might hear it called the base rate.
Right.
They meet about 8 times a year, debate the economic situation, look at forecasts, and then vote on what the bank rate should be. Their target currently is 2% CPI inflation. And crucially, the Bank of England has operational independence to set this rate. Parliament sets the goal, but the bank decides how to hit it day to day. Though technically the government can override them in, extreme economic circumstances, but that's very rare.
Okay, so the MPC sets the bank rate. Now, here's where it gets really interesting for you listening. What does a change in that rate actually do to your wallet? How does it affect everyday finances?
It has a pretty direct impact through several channels. When the bank rate goes up, commercial banks, the ones you bank with, usually raise their own interest rates pretty quickly, both for lending and for saving. So straight away, borrowing becomes more expensive. If you have a variable rate mortgage, for instance, your monthly payments will likely go up.
Ouch.
Yeah, it can cause real hardship if the rises are big or quick. Savers, on the other hand, might get slightly better returns. But the main effect is on borrowing costs.
What about fixed rate loans? They're protected, right?
They are, for the fixed period. If you've got a 5-year fix on your mortgage, your payments won't change when the bank rate moves during those 5 years. That gives you certainty. These loans are usually funded from money markets, so the pricing reflects expectations of future rates. The downside? Well, if rates fall sharply, you're stuck paying the higher fixed rate. And often, there are penalties if you want to repay the loan early.
So pros and cons.
Definitely. But looking bigger picture, when rates go up, it doesn't just affect mortgages. Overall, consumer spending tends to slow down because borrowing is costlier and saving is more attractive. Businesses might borrow less to invest. Demand falls. Company profits might dip, which can affect share prices. Maybe businesses start to cut back, leading to rising unemployment. And all of that ultimately is supposed to reduce inflationary pressure in the economy.
And we've seen that happen quite dramatically recently, haven't we?
We certainly have. Think back, the bank rate was incredibly low for years after the financial crisis. Then it crept up a bit. But then, facing that surge in inflation, the cost of living crisis, it jumped from just 0.25% in February 2022 all the way to 5.25% by August 2023.
Wow, that's a steep climb.
A very significant tightening of policy designed specifically to curb that high inflation. A very direct lever in action.
Okay, so that's monetary policy, the interest rate lever managed by the Bank of England. But governments have another big tool, right? Fiscal policy. How does that fit in?
That's right. Fiscal policy is the other side of the coin. It's about how the government itself, central government, local authorities, public bodies, influences the economy. And it does this through 2 main things: taxation and public spending. Public spending directly injects money into the economy, whether it's building schools, paying nurses, or funding infrastructure. It drives consumption and investment. And taxation obviously is how they raise the money to pay for it all. And it also affects how much money people and businesses have left to spend or invest themselves.
So it's about the government's own budget.
Essentially, yes. You can think about the government's budget in 3 ways. A balanced budget is when what they raise in taxes roughly equals what they spend. Theoretically, that's kind of neutral for the economy. A budget surplus is when they take in more tax than they spend. That tends to take money out of the economy, so it can have a contracting effect, slow things down. And a budget deficit is when they spend more than they raise in taxes. This injects extra demand into the economy, so it tends to expand it.
And when there's a deficit, they have to borrow, right?
Exactly. They have to borrow to cover the gap. The amount they need to borrow in cash terms in a given period is often called the Public Sector Net Cash Requirement, or PSNCR. All these decisions about tax and spend are usually laid out in the annual budget statement, presented by the Chancellor of the Exchequer. It's debated in Parliament, and nowadays we have the Office for Budget Responsibility providing independent forecasts alongside it.
So let's connect that to the listener again. If the government decides, say, to increase taxes across the board, what does that mean for you practically?
Well, pretty directly, increased taxation usually means less disposable income for you, for households, and potentially lower profits left over for businesses after tax. With less money in people's pockets or company accounts, spending tends to fall. That reduces overall demand for goods and services.
Which should help bring inflation down.
That's the idea. It cools the economy. Conversely, if the government cuts taxes, people have more disposable income, they're likely to spend more, increasing demand, which can push inflation up. So it's a direct lever on demand, just like interest rates, but working through a different mechanism.
Can fiscal policy be more targeted, though? Not just broad tax changes.
Oh, absolutely. Fiscal policy can be very specific. Think about taxes on particular goods, like alcohol or fuel duty, or incentives for certain activities, like R&D tax credits for businesses. A good example was the introduction back in April 2016 of a higher rate of stamp duty land tax on purchases of second homes or buy-to-let property.
Ah, yes, I remember that.
That wasn't aimed at cooling the whole economy. It was a specific measure designed to influence the property market, perhaps dampen investor demand, and maybe help first-time buyers relative to investors. Whether it worked exactly as intended is debated, of course, but it shows how fiscal tools can be used in a much more targeted microeconomic way, not just for the macro picture.
Right, so we have monetary policy with interest rates, fiscal policy with tax and spend. But beneath all that, there's this whole complex world of financial regulation, isn't there? The rule book for banks, insurance companies, investment firms. How does that fit in, especially with everything being so global now?
It's a hugely important layer. You're right. Government policies, both monetary and fiscal, obviously affect the financial services industry. But then there's a whole separate body of rules, specifically governing how these firms operate. And it's definitely international. What happens in the EU or the US or global standard-setting bodies can directly impact UK financial firms, especially if they operate internationally or serve overseas clients. It's called extraterritorial effect.
So how has Brexit changed that regulatory picture for the UK? We left the EU, but presumably not all the rules just vanished.
No, not at all. When the UK left the EU, that was January 31st, 2020, the immediate trading relationship didn't change drastically overnight because of the agreements put in place. But legally, the UK brought a huge amount of existing EU law onto its own statute book. This is called onshored legislation or retained EU law. Now, there's an act, the Retained EU Law Revocation and Reform Act 2023, which gives the UK government and Parliament the power to review, amend, or scrap this retained law over time. It also gives UK courts more leeway to depart from previous EU case law.
So we're gradually diverging.
Potentially, yes. And specifically for financial services, the Financial Services and Markets Act 2023 is really important. It gives the UK regulators, primarily the FCA, the Financial Conduct Authority, more power to design detailed rules for the UK market, replacing those that used to come directly from the EU. Interestingly, that act also gives the regulators a secondary objective, alongside safety and soundness in conduct, which is to facilitate the international competitiveness and growth of the UK economy.
That's a significant shift.
It is. It reflects the post-Brexit reality. And just to clarify, when the UK was in the EU, there were two main types of EU law. EU regulations were directly applicable. They became law in the UK automatically. EU directives, on the other hand, set out goals that member states had to achieve, but left it up to each country how they implemented it into their national law. Things like mortgage credit directive or rules on deposit protection limits often came via directives, which the UK then put into its own regulations.
You mentioned global responses earlier. The big one after the 2007-09 crisis was this European System of Financial Supervision, the ESFS. What was that all about?
Right, the ESFS was a direct response to the financial crisis. The feeling was that national regulators hadn't coordinated well enough and hadn't spotted the buildup of risks across borders. So the ESFS was set up to create much more consistent and coordinated supervision across the EU. It wasn't one single body, though. It operates through three main European supervisory authorities, or ESAs, each focused on a sector. ESMA for securities and markets, EBA for banking, and EIOPA for insurance and pensions.
Okay, three specialist bodies. What do they actually do?
They have quite significant powers. They can propose technical standards, which become legally binding rules, aiming to create a single EU rulebook for financial services. They issue guidelines, coordinate national supervisors, investigate if national bodies aren't applying EU law properly, mediate disputes between them, and importantly, they have a strong focus on consumer protection. There's also the European Systemic Risk Board, the ESRB, which sits alongside them, monitoring the financial system as a whole for bigger systemic risks.
And post-Brexit, are UK regulators still involved in this?
Formally, no. The UK regulators, the PRA and FCA, are no longer members or formal participants in the ESFS structures. However, because many UK firms still do business in the EU or serve EU clients, the ESA rules and decisions can still affect them indirectly or sometimes directly depending on the setup. There's still significant interaction and alignment in many areas. We should also mention the Single Supervisory Mechanism, the SSM. This is specific to the Eurozone, where the European Central Bank, the ECB, took direct responsibility for supervising the biggest banks. Another crisis response.
Okay, so that's the European picture, bringing it right back home. For someone using financial services here in the UK, what are the layers of regulation and oversight that protect them?
Yeah, you can think of the UK system as having about four main tiers of oversight. The first level is the primary legislation passed by Parliament. That's the bedrock. Think of the big acts like the Financial Services and Markets Act 2000 and the new 2023 Act we just mentioned. This also includes that onshored EU law.
Okay, the main laws.
The second level is the regulators themselves. Primarily, the Prudential Regulation Authority, or PRA, which is part of the Bank of England. It focuses on the safety and stability of banks, insurers, big investment firms, making sure they don't fail. And the Financial Conduct Authority, the FCA. It regulates how all financial firms conduct their business, aiming to protect consumers, ensure market integrity, and promote competition. These bodies issue detailed rulebooks based on the acts.
So PRA for stability, FCA for conduct.
Broadly, yes.
Yeah.
Then the third level is actually the financial firms themselves. They have their own internal policies, compliance departments, training procedures, all designed to make sure they follow the rules set by Parliament and the regulators.
Right, internal controls.
And finally, the fourth level is about redress when things go wrong for consumers. This includes arbitration schemes, most notably the Financial Ombudsman Service. If you have a complaint about a bank or insurer or financial advisor and you can't resolve it with the firm directly, you can take your case to the Ombudsman, who can make a legally binding decision. It's a free service for consumers.
So a multi-layer system from Parliament right down to resolving individual complaints.
Exactly. It's designed to cover all the bases, from the stability of the whole system to fairness for individual customers.
Wow. We've really covered a lot of ground today, from those big macroeconomic goals governments are chasing, through the tools of monetary and fiscal policy, the interest rates, the taxes, the spending, and then deep into the weeds of financial regulation, both here and how it connects internationally. It really shows how these sometimes abstract-sounding policies and rules are constantly shaping the economy and ultimately your financial world.
Absolutely. And maybe a final thought to leave you with. If you connect all these dots, the global economic shifts, the specific policy choices our government makes, the way regulations evolving, especially post-Brexit, how do you see all that interacting in the next few years? What stands out to you as the biggest challenge or perhaps the biggest opportunity shaping the financial landscape for people and businesses here in the UK? Something to ponder.
Definitely something to think about. That's all for this deep dive. We hope this has given you a clearer, richer understanding of the forces at play in our economic and financial systems. Thanks for joining us.